The pattern says otherwise. $38 trillion isn't a mistake. It's not incompetence. It's not politicians losing control. It's stage 7 of a design that began in 1790 with one man, Alexander Hamilton. Hamilton didn't just create America's financial system. He built a permanent creditor state, a machine designed to bind the wealthy elite to government power, then scale that dependency nationally until the trap becomes inescapable. Today's interest bill is the tell. It outgrows everything: defense spending, education, infrastructure. And it won't be repaid. It can't be repaid. The math says otherwise. You'll learn the exact 7-stage sequence Hamilton designed, why each stage accelerates the next, and how to spot the breaking point before it snaps. Quick payoff. I'll give you a simple metric to track: interest payments as a percentage of tax receipts, so you can see the snap point coming in real time. Let's go stage by stage. Check each box. See where we actually are in Hamilton's trap. Stage 1. The Permanent Debt Doctrine. Debt as political glue. Here's what should terrify you about Hamilton's true genius. He didn't see debt as a necessary evil. He saw it as the ultimate political weapon. 1790. Hamilton writes to Congress, "A national debt, if it is not excessive, will be to us a national blessing." Not a burden. A blessing. The mechanism is brilliant and terrifying. Without shared financial stakes, a fragile union fractures, states go their own way. Elites hedge their bets across multiple governments. But tie their capital directly to federal survival? Now they have skin in. The game. Hamilton's papers make this explicit. The goal isn't rapid debt repayment, it's creating a permanent creditor class whose wealth depends on the federal government's continued existence and expansion. Think about the incentives Hamilton built. If you're a wealthy merchant or a landowner and the federal government owes you money, what do you want? A strong federal government that can tax, regulate, and expand to guarantee your returns. The consolidation mechanism works like this. Take scattered, worthless state IOUs and wartime promises, standardize them into federal bonds with guaranteed interest payments. Make Treasury the single trusted payer that creditors can count on. Do it wrong. No buyers show up, interest rates spike, weak state collapses. Do it right. Cheap financing forever, and a loyal class of creditors who need federal power to protect their investments. Hamilton's correspondence with Robert Morris reveals the deeper strategy. They're not just managing debt, they're manufacturing political dependency. Every bond payment creates a constituency that demands more federal authority, more taxation power, more control. The counterpoint seems reasonable. Hamilton wanted fiscal discipline, the sinking. The fund was supposed to retire debt systematically, but look at the incentive structure he actually created. Regular interest payments become sacred. Principal repayment becomes optional. The system rewards rollover, not retirement. Here's your quick win. Anywhere you see politicians calling debt investment or stimulus while guaranteeing interest payments but never shrinking the principal, that's Hamilton's blessing language in action. The glue worked. Creditors anchored to federal power, but glue isn't enough for the scale Hamilton envisioned. You need a machine to manufacture the tickets. Stage 2, the central bank mechanism, manufacturing credible IOUs. The problem with Hamilton's stage 1, tax collection, is slow, political, and unreliable. But markets demand liquid, trusted paper right now. Enter the first bank of the United States, chartered in 1791. This isn't just a bank, it's a public-private engine designed to manage debt flows, clear payments, and backstop. Treasury auctions. Here's how the machine actually works. The bank capitalizes federal credibility. It supports treasury bond auctions by coordinating buyers. It smooths liquidity crises before they destabilize the whole system. Most importantly, it creates secondary markets where debt can be traded, making federal IOUs as good as cash. The stakes are massive. Without a central coordination node, financial chaos, markets fragment, interest rates spike. The federal government can't reliably fund operations. With the central bank in place, scalable debt issuance, lower borrowing costs, and deeper market dependence on federal paper. The historical evidence is clear. Federal deposits flow through the bank. Note issuance gets tied directly to federal debt holdings. The bank becomes the proto-federal reserve, creating the institutional foundation that survives to this day. But here's what most people miss about central banking. They think bank equals printing press. The real power is settlement coordination and buyer management. The first bank doesn't just issue currency. It organizes the creditor class. It makes sure Treasury auctions clear. It creates the infrastructure where debt rollover becomes routine, automatic, and politically invisible. Hamilton's genius shows in the bank's charter structure. 20% government ownership, 80% private. The government gets operational control. Private investors get guaranteed profits from managing government debt. The consequence, Hamilton intended, a machine that normalizes debt rollover as standard policy. Maturity walls get managed, not eliminated. The national debt becomes a permanent feature, not a temporary necessity. Treasury records from 1791 to 1811 show the pattern. Debt gets refinanced, not retired. Interest payments become the largest federal expense after defense. The machine works exactly as designed. But Hamilton faced a problem. Many small fires are harder to control than one large blaze. Fragmented state debts meant fragmented loyalty. Creditors split their attention across multiple governments. For Hamilton's trap to work at scale, all the financial pressure had to flow through one sovereign. Time to centralize the power and the credit. Stage 3. The assumption gambit, centralizing power and credit. Hamilton's next move was pure political genius disguised as financial necessity. The Assumption Act of 1790. Here's the setup. Individual states carried massive war debts from the Revolution. Virginia owed millions. Massachusetts owed millions. Each state had different creditors, different terms, different political pressures. Hamilton saw the opportunity. Why let states control their own financial destiny when you could absorb all that leverage into federal hands? The assumption gambit works like this. Federal government assumes all state war debts. Exchange disparate, unreliable state paper for standardized treasury bonds. Swap financial chaos for federal hierarchy. But this wasn't about helping struggling states. This was about power consolidation. The winners. Federal authority expands massively. Coastal creditors who held state debt suddenly become federal creditors. Their loyalty shifts from state capitals to Washington. The losers. States lose fiscal autonomy. Future flexibility gets sacrificed to current centralization. Hamilton's correspondence reveals the deeper strategy. He's not just cleaning up state balance sheets. He's creating a national creditor class that depends entirely on federal power. Think about what assumption actually accomplished. Before 1790, wealthy merchants might lobby Virginia's legislature or Massachusetts governor or New York's assembly. Their political attention was scattered. After assumption, every major creditor in America has one target, the federal government. One Congress to influence, one treasury to protect, one political system to capture. The evidence is overwhelming. Treasury records show the debt exchange happened exactly as Hamilton planned. State bonds got swapped for federal securities at predetermined ratios. The federal debt jumped from $54 million to $77 million overnight. But here's the pattern that emerges. Centralization lowers immediate funding costs by pooling risk and credibility. But it inflates moral hazard at the core. When everything flows through one institution, that institution becomes too big to fail. Hamilton knew this. His private letters to creditors make clear promises. Federal assumption means federal backing. Federal backing means your investments are safe forever. The counterpoint sounds reasonable. Assumption created stability. It prevented state defaults that could have destroyed American credit internationally. But look at the precedent Hamilton established. When political pressure mounts, when crisis hits, Washington absorbs the liabilities. The federal government becomes the ultimate backstop for any debt that matters politically. This pattern repeats throughout American history. Savings and loan crisis, federal bailout. 2008 financial crisis, federal bailout. State pension crises, federal pressure to intervene. Hamilton's assumption gambit didn't just centralize Revolutionary War debt. It centralized the principle that politically connected debt gets federal protection. The mechanism worked perfectly. Power consolidated in Washington. Creditors unified behind federal expansion. The debt became a national institution, not a temporary burden. But Hamilton still faced one critical constraint. Hard money imposed limits. Gold and silver could be redeemed. Excess promises could be called in. The debt trap needed one more evolution to reach its final form. The chain had to be cut. Stage 4, the Fiat Foundation. Cutting the chain, gold 1933-1971. For 140 years, Hamilton's debt machine operated within hard constraints. Gold convertibility meant excess promises could be redeemed. Metal reserves imposed real limits on how much debt the system could absorb. The trap was powerful but bounded, until two presidents cut the chain entirely. Here's why convertibility caps the debt machine. When people can exchange paper promises for gold, they can drain the Treasury's metal reserves. Excessive debt creation triggers redemption runs. The government faces a choice: honor the conversion or break the promise. Hamilton's system could scale, but it couldn't scale infinitely. Gold imposed mathematical discipline. 1933, Franklin Roosevelt ends domestic gold convertibility. Executive Order 6102 makes private gold ownership illegal. The government confiscates citizen gold at $20.67 per ounce, then immediately revalues it to $35, a 69% devaluation overnight. The legal transformation is massive. American citizens can no longer convert dollars into gold. The domestic constraint disappears. The Treasury-Federal Reserve alliance gains flexibility to fight the Depression without worrying about metal outflows. But international convertibility remains. Foreign governments can still exchange dollars for gold at $35 per ounce. The Bretton Woods system maintains some external discipline. 1971, Richard Nixon completes the break. Nixon's shock ends dollar-gold convertibility internationally. No more $35 gold window, no more redemption rights for anyone, anywhere. The chain is completely severed. Dollars float free from any hard anchor. Here's what changes fundamentally. Before 1971, excessive debt creation risked gold outflows and forced austerity. After 1971, the constraint shifts from metal reserves to market confidence and interest rates. The stakes flip dramatically. Immediate freedom to fight any crisis without worrying about convertibility, long-run temptation to overissue promises, and undertax to pay for them. Federal Reserve historical data shows the pattern clearly. Pre-1971, the monetary base grows slowly, constrained by gold reserves. Post-1971, explosive growth becomes possible. The debt-to-GDP ratio begins its permanent upward trajectory. The mechanism Hamilton could never have imagined. And once convertibility ends, debt becomes purely a confidence game. As long as markets believe in repayment, new debt can finance old debt indefinitely. Treasury records reveal the transition. Chronic deficit spending becomes normal after 1971. The discipline imposed by gold disappears. Politicians discover they can promise everything and finance it with future obligations. But here's what people miss about fiat currency. The real danger isn't hyperinflation printing. It's silent debasement through persistently negative real interest rates. When the government pays 3% on bonds but inflation runs 4%, bondholders lose purchasing power every year. The debt gets repaid in cheaper dollars. It's default by debasement, not default by declaration. The historical parallel is clear. Britain, after empire, used chronic inflation to erode war debt rather than explicitly defaulting. The same pattern emerges in America after 1971. Your metric to watch: real wage growth versus debt growth. When debt expands faster than wages, debasement shows up in living standards before it shows up in currency collapse. The Fiat Foundation gave Hamilton's machine unlimited fuel, but unlimited fuel requires unlimited demand. The next stage: export the debt and the inflation to the world. Stage 5, the global funding pattern. Externalizing the burden. Petrodollar. Hamilton's machine now had unlimited fuel, but unlimited flexibility requires unlimited demand. You can't just print your way out of debt problems domestically. You need the world to absorb your excess promises and your exported inflation. Enter the petrodollar system, the most brilliant debt externalization scheme in history. Here's the setup. After Nixon cuts the gold chain in 1971, the dollar needs a new anchor, something that forces global demand for American debt. Henry Kissinger finds the answer in Saudi Arabia. The deal is elegant and ruthless. Saudi Arabia agrees to price oil exclusively in US dollars. In exchange, America provides military protection and weapons sales. But here's the critical part. Saudi Arabia agrees to recycle oil revenues back into US Treasury securities. Think about what this accomplishes. Every country that wants to buy oil must first acquire dollars. Every oil transaction creates structural demand for American currency. Every oil surplus gets recycled back into American debt. The mechanism scales globally through OPEC coordination. Oil invoiced in dollars, trade surpluses recycled into treasuries, reserve currency privilege becomes entrenched through energy dependency. The stakes are massive. Benefits: cheap financing from global recycling, international reach for American monetary policy, the ability to run persistent current account deficits without consequences. The cost: fragility if global demand for treasuries ever softens. Federal Reserve data shows the pattern clearly. Foreign holdings of Treasury securities explode after the petrodollar arrangement. Persistent American current account deficits get financed automatically through the recycling mechanism. But here's what the global savings glut narrative camouflages. This isn't natural market demand for American debt. It's fiscal dominance exported globally. Foreign central banks accumulate treasuries not because they want them, but because they need dollars for energy transactions. The pattern Hamilton initiated domestically, binding creditors to government power, gets replicated internationally. Countries that need oil become creditors who need American financial stability. Treasury records reveal the scope. Foreign official holdings rise from $14 billion in 1970 to over $4 trillion by 2020. The world becomes addicted to financing American consumption and American debt. The risk signals are already visible: flattening foreign bid at Treasury auctions, rising term premiums despite Federal Reserve intervention, heavier domestic absorption by American banks and the Federal Reserve itself. The counterpoint seems strong. Japan sustains debt to GDP ratios above 200% through domestic savings. Why can't America do the same? Here's the critical difference. Japan's debt is held domestically by Japanese savers who have limited alternatives. American debt relies on global recycling from countries that increasingly have other options. China's treasury holdings peaked in 2013 and have declined since. Russia dumped treasuries after sanctions. Even traditional allies are diversifying reserves away from dollar concentration. The math says otherwise about sustainability. When foreign demand weakens, domestic institutions must absorb larger quantities of new debt at higher interest rates. The recycling mechanism that made Hamilton's trap globally scalable faces structural headwinds. But global demand still provides enough stability for the next evolution. When financial crises expose funding gaps, policymakers need something stronger than market demand. They need direct intervention. The Federal Reserve balance sheet becomes the buyer of last resort. The liquidity addiction begins. When the 2008 financial crisis hit, Hamilton's debt machine faced its ultimate test. Markets seized. Treasury auctions risked failure. The global recycling mechanism couldn't absorb the sudden spike in government borrowing needs. The Federal Reserve's response revealed the final evolution of Hamilton's trap: quantitative easing. QE isn't just monetary policy, it's fiscal dominance disguised as emergency intervention. Here's how QE completes Hamilton's design. The central bank directly purchases government debt when market demand proves insufficient. Duration gets absorbed by the Fed's balance sheet. Yields get suppressed regardless of underlying fiscal conditions. Treasury auctions get backstopped by unlimited buying power. The 2008 QE programs expanded the Federal Reserve balance sheet from $900 billion to over $4.5 trillion. But the real transformation came in 2020. COVID-19 triggered QE4, $700 billion announced in March, scaling to $120 billion monthly purchases through 2022. The mechanism works through liquidity flooding. Banks receive massive reserves from Fed asset purchases. But instead of lending those reserves into the real economy, they park the excess back at the Federal Reserve, earning interest on reserves. This creates a perverse outcome. Money supply explodes while money velocity collapses. M2 growth surged during QE periods, but the velocity of money, how fast dollars circulate through the economy, hit historic lows. Federal Reserve data shows velocity falling from 2.2 in 2000 to below 1.2 by 2020. The liquidity stays trapped in the financial system instead of reaching productive economic activity. Here's where Hamilton's original vision reaches completion. QE channels newly created money directly to the asset holding class. Stock markets boom, real estate inflates, bond prices rise. But wages stagnate and goods inflation remains subdued until supply shocks force it into the open. The hidden cost becomes wealth concentration on steroids. QE benefits whoever owns financial assets, exactly the creditor class Hamilton designed his system to serve. Working Americans see asset prices rise beyond their reach while their wages buy less. The stakes turn existential for the system itself. Markets now expect Federal Reserve intervention at every tremor. Any attempt to normalize the balance sheet through quantitative tightening faces immediate resistance from asset markets. The evidence is overwhelming. The Fed tried QT, quantitative tightening, starting in 2022. By December 2025, they halted the process entirely. Money market stress, employment concerns, and asset volatility forced a return to balance sheet maintenance mode. The addiction is complete. QE becomes the permanent tool, not the emergency exception. The Federal Reserve balance sheet can shrink modestly during calm periods, but every crisis demands renewed expansion. Your metric to watch: velocity stagnation combined with rising interest to tax receipts ratios. When money stops circulating, while debt service costs accelerate, fiscal dominance becomes undeniable. The counterpoint sounds technical. QE provides necessary liquidity during crises. Markets need a buyer of last resort to prevent financial collapse. But here's what QE actually accomplished. It made Hamilton's debt trap inescapable. When market discipline fails, the central bank steps in. When the central bank steps in, debt capacity expands beyond any natural limit. We've reached the point where ending QE threatens the entire system. The addiction can't be broken without triggering the very crisis QE was designed to prevent. The final stage becomes inevitable. When interest rates rise or growth stalls, the interest bill exposes the mathematical endgame Hamilton built into the foundation. Stage 7. The interest death spiral, $38 trillion in the math. Here we are, Hamilton's final stage. The trap snaps shut. The math is brutal and inescapable. Total debt sits at $38 trillion. Interest payments are now the fastest growing line item in the federal budget, projected to surpass defense spending within years. Here's what makes this a death spiral. Higher average coupon rates as low-rate debt from the QE era matures. A larger principal base that amplifies even modest interest rate increases. Compounding that accelerates regardless of political action. The Congressional Budget Office's projections confirm the trajectory. Even with optimistic growth assumptions, interest expense expands faster than revenue trends, without massive structural reform. The stakes are existential. Tax hikes can't catch the compounding without destroying growth. Spending cuts face political impossibility when interest crowds out everything else. The inflation solution erodes real wages while preserving nominal debt service. Current debt to GDP approaches 125%. Interest to tax receipts climbs toward 20%. Foreign treasury demand shows concerning softness as recycling mechanisms weaken. The math says otherwise about sustainability. Even with reserve currency advantages, compound interest eventually overwhelms any economy when principal never shrinks. Your tracking tool, monitor interest payments as percentage of total tax receipts quarterly. When that ratio trends toward 30%, crowd-out acceleration becomes undeniable. Hamilton's machine worked exactly as designed. The trap is complete. Check the boxes. Debt framed as political blessing. Central bank mechanism created. Power centralized through assumption. Gold constraints eliminated. Global funding externalized through Petrodollar. Liquidity addiction institutionalized through QE. Interest death spiral activated. The counterargument sounds reasonable. Hamilton sought stabilization, not entrapment. The pattern says otherwise. Structures outlive intentions. Incentive systems dictate behavior regardless of original purpose. Hamilton built a machine that rewards debt expansion over debt retirement at every decision point. We're not predicting hyperinflation. We're mapping fiscal dominance and systematic living standard erosion through financial repression. The hypocrisy is staggering. Politicians call this investment, while interest payments crowd out actual infrastructure, education, and defense spending. It's not fine. The exact same pattern. Glue, machine, centralization, unshackling, externalization, addiction, spiral. Hamilton's 7-stage debt trap puts us at stage 7 with $38 trillion and rising. What should terrify you? Interest grows whether Congress acts or not. It compounds automatically. The trap is mathematical now, not political. The debt isn't a mistake. It's not incompetence. It's the final stage of a design that began in 1790 with one man who saw debt as a national blessing. If you remember nothing else from this video, track the interest to tax receipts ratio. It will tell you exactly when the trap snaps completely shut. When that number hits 30%, crowd-out becomes unstoppable. The answers aren't hiding in the future. They're written in the past. The pattern says otherwise about everything they're telling you. If this opened your eyes to where we actually are in Hamilton's sequence, hit the like button so more people see it. The truth is ugly, but it's the truth. And it's time people knew. Subscribe to Financial Rewinds, because we're breaking down the next pattern. How reserve currencies actually die, stage by stage. When stage 7 completes, you'll want to understand what comes after the trap. Comment debt trap below with your prediction for when interest payments hit 25% of tax receipts. We'll pin the most accurate timeline. The math doesn't lie, the pattern doesn't break, and Hamilton's machine works exactly as designed.